Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. DraftKings reported earnings recently, and I think the numbers were really interesting. The company is expecting even more growth than they had given guidance for, but continues to lose money. So, how should investors be thinking about this stock? That's what I want to dig into today. My name is Travis William. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And let's get right to the results. You can see here that revenue was up about 85% to $770 million, but loss from operations was $390 million. That was an improvement from a year ago, so that's worth noting. But a couple of these numbers I think are really fascinating here. Cost of revenue, $522 million. In a digital business, to have cost of revenue that high, I think is pretty alarming. And then sales and marketing expenses, almost $400 million. So spending about 50% of revenue on sales and marketing. The thing that I think investors need to think about is what is sustainable with the online gaming business and what is just promotion based. We've all seen those ads and those promotions where you can get $100 to place your first bet or a free bet online in areas where online gaming is legal. Those are expensive not only to run the ad, but also to actually give that free promotion. Those expenses are going right here to sales and marketing, and they don't seem to be improving. They seem to actually just be getting bigger and bigger over time. I'm going to flip over to the presentation here, and this is where the guidance number was increased. So an increase of about $200 million from guidance that was given in February to now $3.3 billion in revenue expected for the year, but a loss, adjusted EBITDA, which is a proxy for cash flow in the gaming business, is expecting a loss of $315 million. Here's the adjusted earnings per share walk. So GAAP loss per share was 87 cents. Even if you pull back stock-based compensation and other adjustments, you get a loss of 51 cents per share. The other thing is that DraftKings is still diluting shareholders. So this stock-based compensation does come out of the value that long-term shareholders have. Fully diluted shares, about 480 million right now. If we look here at the statement of cash flows, this is another thing that I always look for, especially with digital companies like DraftKings, burning over $200 million per quarter. Now it's an improvement from a year ago, but cash loss from operations is about $200 million. And overall, the cash level has declined pretty sharply. A year ago, $2.2 billion, right now, $1.5 billion. That includes the cash reserves for users. So if you pull that out, cash has dropped really sharply from 1.8 billion to 1.1 billion. We see a similar story on the balance sheet. Now, if you remember, DraftKings does have $1.25 billion in convertible notes, so that does need to be paid off eventually. But this is something that I always look at here is, what does stockholders' equity look like over time? Stockholders' equity should be rising because earnings eventually flow to investors. If you're losing money, that means the stockholders' equity is going to go down. That's exactly what we're seeing. This is just the last 3 months. Stockholders' equity is down $300 million. That corresponds here to about over $200 million reduction in cash on the balance sheet. So there again, you're seeing a company burning cash, and that result in the statement of cash flows and on the balance sheet. The question I think we have to ask about DraftKings and all of these online gaming companies that are focused specifically on online gaming, don't have real world physical casinos, is what is the competitive moat that they have? What's the reason that someone is going to stay on your platform and continue betting with you versus having multiple platforms and just shopping the best bet on any given game? I think over time we've seen that's exactly what users are going to do. They're going to look for the best place to bet. And unlike in a physical casino, that's easier to do when you're online. We've also seen that sales and marketing costs just aren't going to come down. It's still very, very expensive to acquire those customers. DraftKings has seen that since it came public, and I don't see that changing anytime soon. So the question is, when does this company get to free cash flow positive? And I just don't see that on the horizon. That's the reason this is a stock that I'm going to stay away from. As the balance sheet deteriorates, management is going to have to look for funding, whether that means raising more debt or issuing shares, which they might do given the fact that the stock has doubled over the past year. Might be a good time to sell stock, but again, that's going to be dilutive to shareholders. So I think a lot of pressure for DraftKings, and it all stems from the fact that this business is not nearly as sustainable financially as a lot of people thought it was going to be a few years ago. But that's why I'm down on DraftKings stock. What do you think of the results, and what do you think about DraftKings stocks? I'd love to hear your comments in the comment section below. Don't forget to follow Rive Investing. Thanks for watching, everybody. See you here next time.